Hello and welcome to this programme from Baillie Gifford, the latest in a series where we talk to the fund managers of the group's different investment trusts. Today we're talking to Sophie Earnshaw, and Sophie is the co-manager of Baillie Gifford's China Growth Trust. My name is Richard Lander of Citywire, and I'm going to be talking to Sophie about how she runs the trust. So thank you, Sophie. Thank you for joining us today. Always interesting times in China and running money there. And you said recently it's been a volatile 12 months for the trust, and I think that followed on from an equally difficult year in 21 to 22. So how do you, as a fund manager, cope in circumstances like this, and what advice would you give to your investors about how they should cope as well?
Yeah, thanks, Richard. So at Baillie Gifford, we've invested in China for almost 30 years now. We've experienced cycles like this in the past, and I think the key to getting through them is really sticking to your philosophy and your process. So for the China Growth Trust, we're sticking to our growth bias, and we're sticking to our fundamentals-led research. We've gone back to basics on most of our holdings and gained comfort from the fact that their operational performance is coming through as expected. And in addition, we've spent a lot of time working out why returns have been volatile or poor more broadly. And then, based on that understanding, whether the case for China still stacks up. And we think it still does. If I could expand on that a bit, looking back over the last 3 years, China's faced an unprecedented series of challenges. So we had COVID, a regulatory clampdown, and a worsening geopolitical environment. These challenges have hurt private sector and consumer confidence. They've negatively impacted sentiment towards the asset class, and they've resulted in very weak returns. But if we look forward instead of backward, we think prospects for China look much brighter. So, at the broad level, whilst growth in the property sector is likely to remain lackluster, we think the risk of financial stability is low. We think a consumption-led recovery is gradually taking shape, and that the government support for the private sector is likely to accelerate this somewhat. And then with geopolitical concerns, whilst they're likely to remain a headwind to sentiment, we think there are signs that both sides want to stabilize the relationship. And then, more importantly for us, as sort of bottom-up stock pickers, the attractions that China offers to us remain very much intact. So whilst GDP growth overall may be slowing, we continue to find, pockets, very large pockets actually, of structural opportunity. So, areas like healthcare, renewable energy, semiconductors, automation, domestic brands. And then just on the trust portfolio itself, the portfolio itself remains overwhelmingly sort of exposed to these longer term disruptive and secular growth themes. And I think that's reflected in, for example, forecast earnings growth for our portfolio of around 15% per annum for the next 3 years versus the benchmark only 9%. And encouragingly, the operational results of many of our holdings are good or sort of on an improving trend. So we think that with valuations attractive in both an absolute and a relative sense, that it's only a matter of time before the strong operational performance is rewarded with good share price and good returns.
Excellent overview there. And before we leave and look forward, let's just look back a little again. You mentioned those three main factors: zero COVID, the regulatory clampdown, and those geopolitical tensions. Which did you find of those three did you find the most difficult to contend with when you were running the trust on a day-to-day basis?
I think both regulation and geopolitics were difficult. I think understanding regulation and the motivations behind it is really important when you're investing in China. What we saw in the education and internet sectors, it was pretty painful, and it led many to question how much you can sort of trust the regulatory framework. We think you can in the long run, but that shorter periods of volatility are highly likely. And we think that regulation and innovation are sort of intimately connected and shouldn't be sort of viewed in a vacuum. And I think, we've had a decade almost of unrestrained innovation or growth in key new areas in China. And I think it was actually time for the regulator to provide a bit of a check. And if I can just give you a couple of examples here, transactions via WeChat Pay. So WeChat Pay is Tencent's payment platform. They increased from basically nothing to around 1 billion a day over the last 10 years. Now, if we put that in context, Apple Pay only processes around 1 billion transactions a month. Or in e-commerce, for example. So Amazon is 13% of global e-commerce sales. Alibaba now accounts for 29%. So, e-commerce penetration in China now dwarfs that of the US. And let's put this in context. So, with the regulatory backdrop, in the US, we've had 150 years of antitrust law. Chinese antitrust law was only written in 2017, and it only started to be taken seriously in the last couple of years. So China did have a lot of kind of catching up to do, not in terms of innovation. It was innovating and growing much faster, but in terms of regulation. And I think also if you look at the content of regulation, actually in the main, it's been remarkably sensible. And the motivation behind it has been to try and foster, I think, sustainable growth industries for the future. And that's impacted in some cases short-term earnings growth. But in the long run, we think it's actually very supportive for the companies that we own and for their share prices. I think, the real challenge when it comes to regulation isn't the content of it. It's actually the way it's implemented. And that links back to China's, top-down system of governance, where, you get a top governor from a central bureau issuing a regulatory guideline. You get a very overzealous response from local regulators who are keen to impress their bosses. This results in unintended consequences, such as economic weakness, as we've seen. That draws the attention of Beijing. They clarify their position, regulations roll back, and then that balance of innovation and regulation is restored. And I think that's exactly what we've seen over the last year. We've seen the government swing from a focus on disorderly expansion of capital to supporting the platform economy and supporting innovation. So whilst we expect we don't expect this regulatory clampdown to be the last, we do expect it to be corrected and that balance, to be restored. And then geopolitics, I think, was the other sort of difficult one. And then, here, whilst we continue to expect that geopolitics, and in particular, the US-China relationship, for that to continue to provide a long-term headwind to sentiment, particularly in the context of an up-and-coming election cycle, we do think that a worst-case scenario here is unlikely. And actually, over the last 6 months or so, there have been tentative signs that both sides are quite keen to stabilize the relationship. So whether that's, Treasury Secretary Yellen's speech in April, or reported comments by Secretary of State Blinken on his visit to Beijing in June, I think both of those things indicate a more sort of constructive approach going forward. And then just finally on the portfolio and how that relates to geopolitics, we remain very exposed to domestic China. So around 85% of our holdings revenue comes from China, with only around 5% or so from the US. And as stock pickers, we do try and factor geopolitics into our stock analysis on a sort of stock-by-stock basis. So, we're more inclined to invest in companies with strong domestic exposure and where further decoupling is likely a net benefit rather than a net negative.
Right. So when the EU announced today that they were going to investigate whether China was dumping cars effectively in the EU, you didn't worry you too much?
It doesn't worry us too much. China, I think in particular, China hasn't actually been that successful in a lot of these EU countries. Where it has been successful is in EVs and in certain markets where EV penetration is high. And here, we think China has a genuinely sort of very strong both technological advantage and also cost advantage that I think will result actually in it doing pretty well in the long run. in terms of EV exports globally. Perhaps not in the US, but I think potentially in Europe.
Exactly. Declaration of interest. I drive a Chinese EV myself, so there we go. Very interested in that. So let's focus domestically for a second. And you talk about the government wanting to get the economy growing again because it has stalled somewhat. But how committed can the government be towards reigniting growth? Because there are a lot of worries about the indebtedness in some parts of the economy, particularly the property sector. So if they go too much and help the economy in general one way, they risk reigniting problems in another way.
Yeah, so debt levels do, I think, limit the government's ability to offer a very large stimulus package. However, gradual easing is, I think, very viable and is indeed happening at the moment. So, the government had a very prudent approach to COVID stimulus. So I think COVID stimulus was around 10% of Chinese GDP versus around 70% in most developed market countries. And they've also been reasonably conservative when it comes to the property market in terms of trying to cool that over the last decade. So I think actually the government has a number of levers that it can pull. China is one of the very few countries in the world that has and can continue to lower interest rates in response to economic weakness. It can also, and it has begun to relax those restrictions that it put on property in the early 2010s. Actually, in July, the central government gave local and city governments the go-ahead to relax restrictions on home purchases. And in August, we saw Guangzhou, a major tier one city, become the first to act. We expect others to follow suit. And for this sort of gradual easing approach from the government to bear fruit. I think it's also important to remember that the Chinese consumer and the private sector in aggregate remain actually in very good financial health. So the Chinese consumer saved up an estimated 7 trillion of excess savings during COVID. And the private sector, as I said, in aggregate remains in very good health, good balance sheets. And it's actually the private sector that accounts for the majority of GDP growth and the majority of job creation. Both the private sector and the consumer has been hurt, I think, by COVID lockdowns and by the regulatory clampdown. But I think it's only a matter of time before confidence improves and therefore spending and activity improves somewhat. And then just a final note on, what macro sort of means for us. We'd actually note that, macroeconomic forecasts tell us not a huge amount about long-term returns for active stock investing in China. So, for example, China's nominal GDP in US dollar terms has grown tenfold over the past 20 years. So that's around 12% per annum. MSCI China has only returned around 6% per annum. So these unimpressive index returns actually mask fantastic performance at the individual stock level. So, for example, over 5 years to the end of 2022, I think Chinese companies accounted for around almost 25% of global companies who have returned 15% per annum in share price terms. So it's not to deny that China has, structural issues, but it's rather to show that there's a persistent gap, I think, between this sort of perceived kind of macro doom and the sort of hidden kind of micro opportunities that we're finding. And it's really, these micro opportunities where we focus our energies. And it's there that we believe we can add value for our clients in the long run.
All right. Well, let's take that cue and drill a bit down into your portfolio and the stocks that you hold there. So if you had to say in a couple of sentences, what is the common thread of your investments? Obviously the 60, 70 stocks there. And we'll dive into the different sectors in a second, but what is your common thread when choosing this portfolio?
Yeah, I mean, in a couple of words, it would be something like best-in-class Chinese growth companies, that basically. And then within that, some of the sort of big structural trends that we've got exposure to, it would be things like early and late stage platform companies in areas like e-commerce, advertising, or food delivery. It would be exposure to companies in industrial upgrading and robotics. It will be exposure to the green transition, exposure to domestic brands, and exposure to areas such as healthcare.
Right. No, that's great. Okay, let's just take that a little deeper. You mentioned the energy transition there, and from solar to batteries are in there in your portfolio. Is it the case that China is doing things here that makes it a world leader, and perhaps we haven't really taken that on board in the West?
Yeah, I mean, if we look at the big picture first, so China imports around 70% of its oil and around 45% of its gas. And actually geopolitical sort of risks have made energy an even more important item sort of on the national security agenda for China. And this is translated into massive incentives to invest heavily in renewables. And we've seen that over the last decade. And again, it's really private companies here that have led the charge. So China now has around, I think it has 6 of the top 10 global EV battery manufacturers in the world. It makes over 70% of the world's solar cells, and it contributes roughly 2/3 of new global wind power infrastructure. It also accounts for almost 50% of total EVs in the world. And many of the companies, playing to this theme are found in our investment universe. So as I mentioned, we own a company called BYD. So this is a leading electric vehicle manufacturer. And we also own CATL, the world's leading EV battery manufacturer. Actually, BYD is a newish purchase for us. It's one of the few fully vertically integrated electric vehicle manufacturers. So it's the second largest EV battery manufacturer in China. It also manufactures something called IGBT chips, which are crucial for things like ADAS. And we think this vertical integration gives it a fantastic cost advantage and also a speed to market advantage. And it's really executed well on both of those opportunities or those advantages. It's now leader in China in the mass market EV space, but also growing very quickly overseas. We think it's got very exciting prospects ahead of it. I mean, China's EV penetration is now at 30% of new car sales, but still rising, very quickly.
Right. I mean, where does this come from? Is it, this advance that's leading the world? Is it from better universities? Is it from better training for people? More investment from in infrastructure?
I think it's a combination of two things. I mean, really, the government is very keen to push the green transition and the energy transition, partly because, as I said, for sort of energy security reasons, but also because they've experienced some of the negative consequences of climate change, but also pollution. So it was only sort of 3 or 4 years ago when smog in some of the biggest Chinese cities was a real issue, and that was really impacting on everyday people's quality of living. So the government is very keen to push the green transition, and as a result of that, they've offered numerous support packages or stimulus packages, much in the same way that the US is doing now. And then on top of that, you've got a very highly educated workforce. You've got a huge number of science and sort of technology graduates coming out of Chinese universities, and you've got a very vibrant private sector. So, BYD, for example, a founder-led private sector company, its origins is in small consumer batteries, but it's moved into EVs. So it's a combination of those sort of big picture sort of support from the government, very sort of highly educated population, and then a very sort of dynamic and sort of entrepreneurial private sector that I think has given sort of China a bit of an advantage here, a first advantage.
And let's go on to the consumer plays that are there in your portfolio, because I think 4 or 5 years ago we talked about the amazing spending power of Gen Z in China and the development of the middle class there. And then obviously we had the pandemic and that threw everything out of the window. Has that spending power, has that ability, the desire to sort of improve one's living standard and buy things for your home. Has that come back now, maybe even bigger than before the pandemic?
So it's coming back. So I'd say, COVID-related lockdowns hurt confidence and to a certain extent spending power. And here, don't forget that the lockdown in China only ended in January of this year versus 18 months ago in the West. So there's been less time for the Chinese consumer to recover. And as I said earlier, COVID stimulus only accounted for around 10% of GDP in China versus 70% in the West. And it also did not take the form of direct to consumer handouts. Instead, as I said, Chinese consumers have saved up an estimated $7 trillion of excess savings, which they're only just sort of starting to unlock as confidence improves. So, some of our Generation Z or sort of consumer platforms have been hit by weaker spending. So we've seen, for example, Li Ning, which is a preferred sportswear brand among younger consumers, face a few inventory issues, and they've been increasing discounting rates, which has hurt the performance of the shares. We've also seen Pop Markets. It's a collectibles company that's very popular with Gen Z, post a bit of a slowdown in 2022. But for both of these companies, we think that demand correction is temporary or cyclical, and that as confidence improves, so will their numbers. We have started to see very good numbers for a lot of our internet platform holdings, which I think suggests that that consumption is gradually sort of recovering quite well. So, Alibaba, the world's leading e-commerce platform, or Tencent, China's most popular social networking app, they both saw a return to double-digit top-line growth in their most recent quarterly results. More importantly, both companies benefit from very large structural growth opportunities. And both, again, remain very attractively valued. So, for example, Alibaba's e-commerce business, if you strip out cash and investments, it's trading on a single-digit price-earnings multiple. ByteDance, our only unlisted holding, also delivering very strong, double-digit top and bottom line growth. So, I think we're seeing from a number of our holdings that the recovery is, slower than many expected, but it's gradually coming through.
Right. So let's talk about valuation for a minute. And you mentioned some companies there that are getting into single-digit price-earnings ratios. Just talk us through a couple that you've retained or indeed added to on valuation grounds, and are these single-figure PE bargains all around for you to pick up?
So we haven't made any big changes to the portfolio, particularly in the last 6 months. So I think we're only running at around 5% turnover versus an average of sort of 20%. But that's because a lot of our, given the sort of performance of the asset class, and the private sector's sort of derating, a lot of our holdings have sort of derated. And we're happy with the overall shape of the portfolio. So that exposure to the private sector and those pockets of structural opportunity, we think we're very well placed. But there have been, I guess, a number of areas or a number of companies that we've been able to sort of take advantage of. So, for example, we added to SG Micro and Shenzhou International. SG Micro is one of our sort of little giant companies. So it's an analog semiconductor company. The chips that it produces, they convert real world signals such as sound and temperature into digital signals. And actually the opportunity for this company, again, I think has been increased or accelerated as a result of geopolitical tensions, because one of China's biggest import bills, actually bigger than oil, is semiconductors. So it's keen to increase self-sufficiency there. SG Micro shares have been very, very weak as a result of what we think is a temporary cyclical dislocation. So we've added to that stock to take advantage of that volatility. We also added to Shenzhou International. This is a garment manufacturer I think it's actually a supplier to Li Ning. And it's been hit, I think, because the consumption recovery story in China has sort of disappointed, but very, very well run company, fantastic management team, and again, an opportunity where we think this is a cyclical issue. It's a great time to add.
Great. And obviously you've lowered your conviction on some companies, and a couple have moved out of the portfolio. What sort of triggers that decision to say, I've been patient enough, but I don't see this one working out for me?
Yeah, I mean, so process-wise, we review all of our holdings on an 18-month sort of rolling basis, or more urgently, if there's been significant news on the company. And in general, we tend to sell or reduce if the valuation is no longer attractive, or if our view relative to the market's view is no longer as differentiated, or if the investment case we think is no longer working. So recently we reduced two companies, Eston and Innovance. Both are in that industrial upgrading sort of robotics sort of part of the portfolio. Innovance in particular has actually exhibited fantastic operational performance. So for the past 3 or 4 years, it's almost trebled its revenue and profit and its share price. We think part of that performance is structural, so it's vastly improved the quality of its products and its technology. But we think it's also benefited from supply chain disruptions that some of its multinational competitors experience. So we've reduced marginally on the back of strength, and to sort of guard against a potential air pocket in terms of demand market share as these COVID disruptions ease. We also partially sold TigerMed. This is one of our healthcare holdings. And we completely sold a number of companies where we thought that the investment case was no longer working. One of the key parts of most of our investment cases, or a key kind of criteria to get into the portfolio, is sort of roughly long-term alignment with the government. And we thought that Baillie and Lufax had both sort of fallen foul of that. So we decided to sell both of those companies.
Right. Again, looking at the report you presented to shareholders a short while ago, you described China as an attractive mix of risk and reward. Do you think it's getting more attractive now as time moves on?
I mean, Chinese equities, after a brief surge in December and January post the reopening, they've given back most of their gains, and the index is still at a sort of similar level to end of 2016. The A-share market in particular has delivered strong earnings growth, but has been derated over the past 5 or 6 years. I'd say more broadly, sentiment towards the asset class appears very negative, and in our view, consensus or the market view is too pessimistic. We think a lot of the sort of market's concerns are already priced in. And as I said, we are starting to see the beginnings, we think, of an improvement in the domestic economy, particularly where consumption is concerned. And then, for us as active investors, as I said, earlier, we do still think China continues to offer these big picture sort of structural opportunities that should persist, regardless of whether GDP grows at 5, 3, or 1%. So I would say that China still offers an attractive mix of risk and reward.
Great. Just want, as we move to the end, ask you a couple of questions about China's place in the world, because you obviously have great faith in it and the companies that are doing great things there. But there are quite a lot of large investors overseas who think that China is just uninvestable because of the capriciousness of the government, and this obviously offers less support in terms of fund flow for the equities price there. Does that worry you, or you just think, let them do what they want to do, and I'll do what I want to do?
Yeah, it's a good question. I think a couple of points. I mean, the first one, I think it's important to remember our starting point here. So the A share market only has around 3 or 4% foreign ownership. It's very domestically owned and focused. The Hong Kong market is much more diversified, but in aggregate, China's representation in global indices such as MSCI ACWI is less than 3.5%. China's weighting is actually smaller than Apple, the company. So that would be the first point. Don't forget where we are, the starting point. Second, we have had a really awful 3 years. And sentiment does tend to be pro momentum. So it's no surprise that I think, these calls that China is uninvestable have sort of gone up after the experience we've just had. And I do think that once conditions improve, some of that sentiment may turn. And then finally, just in the longer run, we do think that there are potentially other pools of capital that could replace, particularly US money in the market and potentially provide support for equity prices in China if you were to see a real sort of marked continuation of decoupling. So, pools of capital, for example, in South America, Asia, or the Middle East.
Right. And just following on from that, China, to a certain extent, is less the flavour of the month than it was a few years ago. And then you have India making a big push, hosting the G20, and the Middle East coming onto the scene as well, with various initiatives to make it a place to invest. Is this going to be detrimental for China as India and the Middle East start to shine a bit more on the global scene?
Again, from this sort of current starting point, I don't think so. I still think that, as a firm, we continue to come back to China as a place where you can find world-class, structurally growing companies. And I think, China continues to have a number of advantages that mean that this will continue to be the case for the next, decade or longer. A little flippantly, but I also know that, the market itself is much cheaper in aggregate than a market like India. I think MSCI India is trading on historic 27 times earnings versus MSCI China on 13 times. So I think there's a bit of a valuation opportunity here as well.
Great. Let's move on to some questions. One I'm going to start with is about data, saying that when you talk about improvement in the domestic economy and that people are now spending, how reliable do you think is that data that leads you to those conclusions?
Yeah, I think it's reasonably reliable. So we don't just rely on the data that the government publishes, although to be fair, China does publish a lot. We also rely on some of our third-party research providers, which have tried to compile, their own activity indexes, for example. We then tend to cross-check the data that we receive at sort of macro level with, on the ground data from, our office in Shanghai and the research that we do there on the ground, and also from the companies that we invest in. So, one of the most positive signals for me recently has just been the improvement in a lot of our companies' holdings results. So as I said, both Alibaba, Tencent returning to double-digit revenue growth after a pretty poor, couple of years. Meituan Dianping, our food delivery platform company, delivering very strong top-line growth. ByteDance, similar situation. In the industrial, a number of our industrial automation and broader sort of industrial holdings also starting to post very strong results. And even in the financial sector, so, one of our largest holdings, Ping An, a key private sector life insurance company, also returning to double-digit value of new business growth. Yeah.
Great. Okay, back to the portfolio itself. This question is, you've got one, I think you mentioned one unlisted company in the portfolio. Are you keen? Is there potential to increase the number of unlisted companies there?
Yeah, again, we are keen. We've got a cap on unlisted investments of 20%, and we're nowhere near that cap at the moment. We've got one unlisted investment in ByteDance, which is around 5 or 6% of the portfolio. Very keen to increase our private exposure, but we want to make sure that we get the right companies in there at the right price. So over the last couple of years, we've seen a number of companies come to us, and we haven't quite got over the line, largely on valuation grounds for a number of these companies. But that isn't to say that in the future there won't be more opportunities. We think there will, as is the case with, I think, the US market. Chinese companies in some sectors are putting off listing until much later in their development. So actually having an ability to get access to these investments before they're listed, I think, could be really accretive. It's one of the main benefits, I think, of the trust structure. So we would expect that private weighting to increase, but only with the right companies and at the right valuation.
Right. Okay. Another question is, when did you actually last visit China? Have you been since the lifting of COVID, and what did you find there?
Yep. So I was in China in May of this year. It was a fantastic trip. It was a joint trip with actually both of the managers from Scottish Mortgage. So it was that combination was fantastic because obviously those guys invest globally. So hearing their sort of point of view on some of their global perspectives on some of these Chinese companies was really very interesting. We spent a week in China, traveling around, seeing most of our large internet platform holdings, including ByteDance, seeing some new ideas in the semiconductor space, and then seeing a number of competitors to our existing holdings. What struck us, for me, prior to going in May, I was last there in January 2020. Actually, really what struck me was from our platform companies in particular, there was a greater degree of confidence in both the domestic economy, but also the management of the domestic economy. So a lot of positive comments from a number of our holdings on Li Qiang, the new premier. There was, in contrast to a lot of the reporting that you read in the West, there was still, I think, a good degree of animal spirits and a good degree of, I'd say, optimism. If you'd asked me that question sort of a year ago, I think we were just in a less good place. In May, it was striking that there was more positivity, basically. So yeah, it was a great trip. Great to be back on the ground.
Great. Going back again soon, or plan for next year?
So I'll be there again, probably end of October or in November at some point.
Okay. Couple more questions before we have to wrap up. One is, we touched on this, the real estate sector is just a bit of a mess, really. I think it'd be fair to say, and obviously you don't invest there, but do you think the problems that it's causing in the wider economy are a threat to your portfolio?
No. So, as you said, first point to make, we don't have any real direct exposure to the property sector. We do think of it as a sector that is likely to see a stabilization, but to be sort of lackluster in terms of growth, and then therefore not really an area where we'd be hunting for opportunities in the portfolio. I think it's fair to say that the weakness in property is having an impact on overall growth within the economy. But I think some of the headlines that we read about, the risk of financial instability is, we still believe that the risk of financial instability from the real estate sector is low. A couple of points to make here. So property sales are down almost 50% from their 2021 peak. So activity is depressed, but prices have barely budged. And I think this is a key point. China has never experienced the sort of asset price bubble that has precipitated almost every property market crash in developed markets. Property prices have grown at around 7% over the last decade, but income growth has surpassed that. And property actually on average remains affordable. And whilst, developers such as Country Garden, which has hit headlines, have become over-indebted, the Chinese consumer actually remains in pretty good health, as I've, already talked about. So, and as we talked about in the conversation, the government can't, offer a very large stimulus package, and I don't think it wants to, but it can gradually ease, and that's what we're seeing. And I think what we will see is just a stabilization in property, partly due to the government's gradual easing approach, partly due to activity improving as consumer confidence improves and as private sector confidence improves, and that China will sort of kind of gradually grow out of this. So we aren't too worried about it at this point in time.
Okay. Final question. Another worry, perhaps, is the tensions over Taiwan seems to be growing. Do you think this keeps a lid on valuations of stocks, no matter how well they're doing, how fast they're growing, how reasonable their price earnings ratios? This is looming in the background and is obviously unpredictable, and we're not here to predict when or if China might invade Taiwan. But do you think that's a factor weighing down on everything?
I think it has been a factor, particularly over the last sort of 2 or 3 years. But I would argue that, we're in a place now where I think a lot of those concerns around sort of geopolitics more broadly, or Taiwan, are already in prices. So I think, again, remember where we are, remember our starting point now. And yeah, we're bottom-up stock pickers. We remain very humble in terms of our ability to predict sort of geopolitical events. But our 2 cents on this would be that on Taiwan, it's a very sort of low probability, we think, but high impact event, and it's low probability because of a number of reasons. The incredibly high stakes involved, the fact that a defeat here would, I think, seriously threaten the legitimacy of the government. The fact that it would be a very difficult endeavor in a military sense, which again greatly increases the chances of failure. And then because, the government, contrary to sort of Western reporting, the government has been, I think, more focused on their domestic commitments than they have been on sort of foreign policy. These promises to increase living standards, deliver a prosperous society by 2035, all of these domestic commitments would be unachievable, in the event of a worst case scenario. So I think a lot of the concerns are already in the price, and that we continue, the risk of something happening here is low probability, but obviously high impact.
Right. Well, that's it. That's all we've got time for, I'm afraid. Thank you, Sophie, so much for your time and your insights into this ever fascinating part of the world. And thank you all for watching. We do have more sessions like this coming up, so please stay tuned, keep your eyes out for those if you found today useful. And just to thank you in the audience once again for tuning in.